So most investors think that the best way to invest in alternatives is to go direct, right? Go direct to the sponsor. And we've all done that. We've all invested solo by going direct to the sponsor, bringing a $50,000 investment, maybe a $100,000 investment. Maybe we found out about that deal on Facebook, or a friend referred us to a sponsor who's doing a multifamily, an apartment building. Maybe it was a mobile home park or a self-storage facility. We've just about all done it. But what I want to show you is how much energy and time and how much risk you're taking on yourself versus how much better and how much financially better it can be for you to invest through a fund of funds in the same exact deal. So in today's video, I'm going to go through this example, the same deal, a deal that my fund did probably about 12 or 14 months ago. We invested in a self-storage facility. And I know the terms because I know those sponsors well. I know what those sponsors offered their investors. And I'm going to use the term retail investor today. It's not very flattering, but if you're out there going solo into deals, you are a part of what's called the retail investor community. You are the lifeblood of some of these deals. They love you because you're paying retail, and you come in and you bring in lots of money. You don't ask lots of questions, and typically you're not a big problem to them. So they love you because you pay retail. What I want to show you is how to start buying investments wholesale. We spend Costco and Sam's Club are some of the biggest money makers here. Why? Because they attract people who want bargains, who want to buy in bulk. And that's exactly what we do through a fund of funds. If you don't know what a fund of funds is, it's simply a structure that's set up to invest in other funds and in other syndications. So yes, there are two layers there, but I'm going to show you how that can benefit you and how you can actually come out better financially. You can come out better seeing more deal flow, and you can come out way better on saving your time and spending your time on things that you're better at, right? So let's get into this exact deal. Like I said, this is a it's a self-storage facility. And I know for a fact that the minimum investment, if you did a $50,000 investment, that they would offer you a 60-40 split. That means the investor at the end of the deal gets 60%. The sponsor gets 40%. I know that for a fact. Originally, we were talking to this sponsor, and of course, we were going to bring more money, and that's why a fund of funds works. It's if you're going to do wholesale, you're going to have to buy more, correct? So I don't think it was even that high. I think that we agreed to bring 500,000, and originally they were going to do, I think, a 75-25. But you know what? We got to working with them and really hammered this out. We got all the way to a 90-10. Now, a lot of people say, how in the world could you get a 90-10? How could they even make money on the deal that way? Well, the truth is they raised, I think, $3 million. And they only did this 90-10 for us, and it was only a 500K amount. I think that might have been $1 million, but we still hit it. So they did this because we made it easier. We brought them a large check or a big sum of money, so they did this for us, okay? So if you went directly in with them, not only did you have to bring 50K for these terms, you had to also do your own due diligence. You had to spend hours reviewing this, hundreds of documents to look over if you knew what to ask for and look at, if you knew how to do the market study. If the problem with the average retail investor, they don't know what to ask for, they don't know what due diligence to do. Also, you've got a big one here that most people don't do. You got to do a background check. You got to know. Now, the cool thing is yes, we did a background check, but I knew these sponsors. I knew them personally. Sat down, had probably met them in two different places, if I'm not mistaken. I met them in Orlando first, and then followed up later in Portland at another event with them. So I knew this sponsor, but we still run our background checks. Retail person should do all this stuff, but the truth is they don't. Okay, and that's why we're seeing a lot of retail investors have lost a lot of money, unfortunately, in multifamily. Now, we can argue that those were blind. A lot of those investors were blindsided by interest rates, okay? But there were some warning signs. I would argue that, yes, there were some warning signs. You should have looked at the market to see that they were overpaying. Were they getting good deals? All those things. That's irrelevant here, because what we want to do is just show you how investing in a fund like my fund, a fund of funds, in the same exact deal, how you can come out better. And the reason we're going to do that is this 90-10 split. So at the end of the day, yes, my fund has its expenses and fees, okay? But I ended up, what I took, I think on this deal, my fund did a 15%. So I'll have to look at this. So I do a 1585 with my investors, or the other way around. So what we've got to do to figure out what my investors made is take the 90 and take the 85, and that's going to get you the number. So let me do that real quick, and you can do it at home. You may be able to do it in your head. I can't. That number ends up being 76.5. So my investors got a 76.5, and oh boy, I'm going to get to show, what is that, 23.5? Hopefully that's right. That's what my investors ended up getting. Okay? I should have done the math to show you that 50,000 invested here, that might, over a 5-year turn, I hate to guess, but might bring back 95K here, and 50,000 invested over here probably brings back at least 100 or more. Okay, so there's more profit here because of the negotiation that took place. You get to leverage my relationship. You get to leverage my team that does due diligence. I'm part of a team. I may do one portion of the due diligence. I've got friends who are engineers, math dudes that jump in on the numbers part. And I've got friends who are real estate brokers. They jump in and do the market research because they have access to the tools. These are tools you don't have access to if you're a solo investor. So at the end of the day, it is such a no-brainer to invest in a fund of funds that is looking out for you, that's going and negotiate better terms. Why? Because we're buying wholesale just like Sam's Club and Costco does, and then we're passing those savings on to you, and somehow we make a profit. Yes, but is it better? You're shopping, you go out and you're shopping for groceries and you're shopping for things at Costco. Why do you shop there? Because you want a better deal. You want your money to go further, right? And not to mention, you want to do the best level of due diligence that you absolutely can. I guarantee you, my investors have less risk over here. Even though it's the same deal, we know things that they didn't know over here. We know things, the relationships, we know more about the deal, we know more. We mitigated our risk on this side. The retail investor doesn't. And that's why a lot of retail investors have been burned in the alternatives world, especially multifamily. So hopefully this helps you to see how, just because there's a fund of funds involved, or you're coming in at a level that's not exactly with the sponsor, you should ask these questions. You should be able to find out, what is the sponsor offering their investors, and what can I get through this fund of funds that I'm considering, and what are the other benefits that are there as well. I hope this helped you to see the difference in investing retail and investing wholesale. If you have questions about this, I'd love to jump on a call with you. If there's somewhere below this video that you can click, you can follow that link to get more information. But again, it pays to invest wholesale.